Welcome back to the Tesla Daily News Podcast. Today is Friday, January 2nd, 2026. In the next few minutes, we're going to focus on the handful of Tesla developments most likely to move the stock this week: delivery expectations, Berlin production plans, Tesla semi-charging progress, and what the market is signaling heading into the new year. Story 1. Tesla just did something investors don't see often, and it's all about deliveries. Tesla published a compilation of analyst estimates ahead of its upcoming delivery report, and several market watchers called the move highly unusual. The context here is simple. Deliveries are the number that tends to set the tone for near-term sentiment on Tesla, especially when the market is debating demand, pricing, and margins. The key detail: one report cites a Tesla-compiled average of analyst estimates for fourth-quarter deliveries at about 422,850 vehicles. If that number is realized, it would be roughly a 15% decline versus the roughly 495,570 vehicles delivered in the year-ago quarter. Impact for investors: Tesla does not usually step out ahead of the print to spotlight street expectations. If deliveries come in below that compiled consensus, you could see fast downward revisions to near-term revenue and gross margin models. If Tesla beats it, the stock could catch a relief rally because sentiment is currently leaning cautious. Takeaway: the most important catalyst right now is the delivery number itself, but Tesla's decision to highlight consensus tells you management understands how fragile expectations are and is trying to frame the market's baseline. Story 2. Michael Burry says he is not short Tesla. Sentiment check, not a fundamental change. Michael Burry, famous for The Big Short, has been tied to Tesla skepticism before, and headlines this week clarified that he is not currently shorting Tesla. This matters because Tesla often trades on positioning and narrative as much as on fundamentals, especially around major catalysts like deliveries. The detail that matters: the same coverage also points back to that approximately 422,850 delivery expectation and the implied year-over-year decline. Impact: Burry not being short is not a bullish data point by itself, but it can reduce the big-name short pressure narrative at the margin, which sometimes amplifies volatility in Tesla options and short interest chatter. Takeaway: treat this as noise unless it coincides with hard data, deliveries, margin guidance, or a major product ramp. Story 3. Gigafactory Berlin plans to scale production again in 2026, despite a weak German EV market. Tesla's Berlin area factory in Grünheide is expected to push production higher in 2026 following steady growth in 2025, according to a report in the European business press. The broader context is that Germany's EV market has been uneven, and European demand is competitive with pricing pressure and rising Chinese competition. Details: the reporting frames Tesla as optimistic about increasing output at Grünheide in 2026 after a year of ramp progress. Even without exact weekly run rate numbers in the article, the strategic signal is clear: Tesla is not planning a defensive crotch in Europe. Impact for investors: higher Berlin output can support faster delivery times and reduce shipping complexity for Europe, which matters for cost and working capital. But there's a key risk: if European demand is soft, more capacity can translate into more discounting, and discounting tends to compress automotive gross margin. Takeaway: watch for two things together: Berlin production rising and European pricing stability. If production rises while incentives grow, the market will assume margin pressure. Story 4. Tesla semi-charging hits a visible milestone: 1.2 megawatts. Tesla released a video showing the Tesla semi-charging at an impressive 1.2 megawatts. The context here is that electric trucking lives or dies by two constraints: charging speed and charging availability. Fleet buyers do not just want an electric truck, they want predictable uptime. Details: 1.2 megawatts is a very high charge rate, and it signals Tesla is getting closer to a practical long-haul use case, at least technically. The missing piece is broad deployment. Megawatt-class charging needs hardware, grid upgrades, and site build-outs. Impact: near term, semi is still a small revenue contributor. But the stock-moving angle is the optionality. If Tesla can scale semi-deliveries and pair them with a charging ecosystem, it opens a new total addressable market and potentially higher software and services attachment over time. Takeaway: this is a real technical proof point. Investors should still demand evidence of volume production, fleet contracts, and charging network build-out timelines. Story 5. Tesla is showcasing the full ecosystem in Taiwan: vehicles, energy storage, V4 supercharging, and a humanoid robot. At the 2026 Taipei Auto and New Energy Vehicle Show, Tesla displayed Model Y, Model 3, Model X, and Cybertruck, along with V4 superchargers, its third-generation wall connector, Powerwall home storage, and the second-generation Tesla bot. The context: Tesla's long-term valuation debate is whether it's just an automaker or a broader platform across energy and autonomy, with robotics as a potential future pillar. Details from the show coverage emphasize the ecosystem angle: charging infrastructure plus home energy storage, not just cars. While the article is regional and promotional in nature, it highlights Tesla's go-to-market approach: sell the car, enable the charging, and upsell energy products. Impact for investors: the energy segment, especially storage, is increasingly important because it can diversify revenue and smooth cyclicality versus auto demand. The robot is not a near-term financial driver, but it helps keep the AI and automation narrative alive, which can matter for multiple expansion when risk appetite is high. Takeaway: energy and charging are the tangible businesses to track. Robotics is a long-dated option. Treat it as such in your valuation assumptions. Story 6. Battery supply chain watch. Graphite names are moving amid China tensions. A separate markets report notes graphite mining stocks are rising amid geopolitical tension with China and expectations of continued battery demand growth. For Tesla, the context is that batteries are still the core cost driver of EVs and energy storage, and supply chain volatility can show up as margin volatility. Details: the article focuses on investor excitement around graphite and broader battery materials. Even if Tesla has diversified suppliers, market tightness and geopolitics can influence input costs and availability. Impact: if battery material prices rise meaningfully, Tesla can respond with pricing, chemistry shifts, or efficiency gains, but those adjustments take time. In the short run, cost inflation is usually a margin headwind unless demand is strong enough to pass through. Takeaway: watch battery material inflation as a quiet but important variable in 2026 margin expectations, particularly if Tesla is also using incentives to defend volume. Before we close, let's tie it together. Today's big theme is expectations management. The Street's baseline is a fourth-quarter delivery number around 422,850, and the market is braced for a year-over-year decline. Against that backdrop, Tesla is still investing. Berlin wants more production, semi-charging is demonstrating real progress, and Tesla continues to push the full ecosystem story, including energy storage. For tomorrow, the big thing to watch is the delivery report timing and the reaction, not just the headline number, but also any clues on regional mix, incentives, and whether production is running ahead of demand. If you found this helpful, subscribe to the Tesla Daily News podcast and follow us for a fresh investor-focused roundup every day.